Welcome back, traders. This is my lecture notes on ICT's 2025 lecture series, where I give you my opinions and key takeaways, and hopefully you'll walk away with some additional insights. Today, we'll be watching his NASDAQ weekly summary on February 28th, 2025. I was on a trip and didn't have the time to watch it yet, so this is still going to be my first viewing. It does look like a long one, so I will skip over some non-essential parts, but as always, the original video will be linked in the description. And if you could, before we get started, give this video a like and subscribe if you haven't done so yet.
All right, so this is the weekly summary, February 28th. With that, let's take a closer look at the daily chart for NASDAQ. You know that there was two levels I was referring to on the daily chart for NASDAQ. Those being the relative equal highs here, which would naturally have buy side resting above it, and then this low down here. Now, these independent lows here, I also mentioned them individually. So they were targets as we were cascading lower. Each one of these were significant levels to aim for, but my focus was, and I took your attention to this one here, and then trade down into this inefficiency. But I stated that until we got outside of these highs or below these lows, the market was going to be held in a holding pattern, if you will. So it makes it difficult. But when the market does, in fact, go after one of these first, be it buy side or sell side, then the market would loosen up and you'd start to see a lot more volatility. This gap in here, I used two of my PD arrays characteristics and blended them together, that being the volume imbalance and the actual gap. Okay, so we watched this in here, and I had a interest in seeing it go higher. What I'm talking about is the bias on the daily chart, meaning that we would go up first to take the buy side out here, then the sell side. As you can see, the market does in fact trade after using this gap or volume imbalance hybrid, if you will. It uses it as support here and sends it above to clear the buy side above these relative equal highs. And then the remaining portion of this area here is completely rebalanced because we traded up into it here, marking over top of this single down closed candle from that candlestick's low. You can see we repriced back to it. We spent some time back and forth and then left it. That means that all of this now is a balanced price range after taking liquidity. What kind of liquidity? Buy side. So now, because it took this side first, it's reasonable to expect it to start working towards the lows here, 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 finally here, and down into this inefficiency.
So far, everything is in line with my market outlook as well. If you've been watching my weekly outlooks, you'll know that I said I was looking for price to take out these relative highs, but I wasn't sure if we're going to make a new all-time high. Then we traded lower, and then I said if we get below this gap, it doesn't look like there's a gap, but from this close to this open, if we get below this gap, then I'll be looking for price to come down for the sell side below these lows and back into this inefficiency. My only hiccup was that I was a little stubborn, wanting to see price retrace back into these civvies, but overall I had a pretty good read on the higher time frame. Now in my recent market outlook, I said I was looking for price to get above this fair value gap, use it as inversion, and then we can look to rebalance some of these inefficiencies, with this lower civvy being the likely target. Now let's see whether or not Michael will give us his thoughts for the near future.
So we use this gap, volume imbalance, pseudo PD array, blending both characteristics, and it was something I simply wanted to do that. So in this gap area here, okay, once we traded down below it, we can grade that, meaning that we're going to put a Fibonacci over top of it, draw from the candlestick's close down to the open of the previous candlestick. Okay, so we're using gap theory there. And all of these levels here, you can see how we went down below the gap on this candlestick, and then we opened here on Monday of the week we just closed in trading. So Monday we opened up here, we traded up into the lower quadrant of this inefficiency. So trading here, it doesn't even find its ability to get up into the consequent encroachment of that gap being 21,839.50. You can see that here. See how it failed to go up to that? As I taught in 2024's mentorship on the YouTube channel, when my PD arrays fail, that shows a significance in directional bias. When a PD array fails to get to its consequent encroachment, if it's a gap, or if it fails to get to its mean threshold, an order block. If it fails to do that, whatever direction it's moving in, it's signaling, if you will, an excessiveness in terms of bullishness or bearishness. So since we've taken the buy side here first and we start to trade lower, our focus is on these lows here, 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 and down as much as this inefficiency here. So on Monday, we open trade up into the lower quadrant of that gap and then breaks lower and attacks that low here. The next day on Tuesday, we open small little rally higher and then we drop lower again. Next day we open, we have a mixed day. So this is an inside day. Whenever there's a bias that's strong, one-sided, in other words, if it's bullish, or in this case, we'll use it here, when we're bearish and we're looking for these lows and this low to be drawn to, when the market breaks down like that and then creates a small inside day, they are like a spring being twisted and compressed even tighter. And eventually, when it's let go, you have a lot of energy that's released. And it goes usually in the direction of the bias, which is the drawn liquidity, these lows, that low, and this inefficiency, as I guided this from the daily chart over the last couple of weeks. So the very next day, on Thursday, we open, we trade higher. The open, trading up into the high that fails to make even a tap back into the previous day's high. It drops aggressively, the largest range of the week, and then trades through our target here. And the very next day on Friday, we open, trade down, trade into the inefficiency here, and then look at this monstrous return back up into the range on Thursday.
Okay, so a key takeaway for me here is this price compression or inside day. Normally, when I see a big move like this and then a small indecisive day, I'm thinking to myself reversal. That's why I was stubborn in thinking price should retrace back to one of these previous SIBIs. I guess I could still do that, but instead I should be viewing this as price charging up an attack for the higher time frame target, either on the next day or the day after that if we get two small range days in a row. In this situation, I want to allow price to oppose the higher time frame bias without me and only trade in the direction of the higher time frame bias. I think this will give you higher probability and greater reward to risk.
Every single day, I'm looking for new information that's derived from this daily time frame. So as the weekly range starts here, I'm watching all of this price action in here. All of this is back and forth price action. So this is all like a holding pattern. So from this buy side liquidity and this low, the market's being held. Okay, so the information isn't going to be as pure as it would be in a market that's a lot more fluid, meaning that think of this as chaff, okay, or confusion, or a smokescreen. So if you had the ability or technology on this day here to look through all this, like with an X-ray perspective, if you will, what would you see beyond the veil of this candlestick here? This. Notice this immediate rebalance occurs inside of the close proximity of this gap here. We open on Wednesday. Here, we trade up. We touch the previous Monday low. So when it does that, that's an immediate rebound. So we'll see that on the lower time frame. I'm watching these things occur as they form, but I'm monitoring this level here because it's outside of this, to the left of all of this back and forth holding pattern. Okay, so what this all represents is time distortion. It was very, very troublesome working inside these ranges. There's a lot of give and take back and forth and a lot of basically consolidation, choppiness, and then one or two moves that occurred, and that was it. And if you weren't part of them, you weren't really participating in the moves. So what I'm doing is I'm looking through all of this to the left of it, and my attention is right there. This gap is energetic away from the retracement went down here, this low that created the sell side liquidity pool that we were aiming for. This run here, this is like a breakaway gap. It never came back down in until later over here, but that was after it made the high on the daily chart. So that's all-time high. So this gap is very, very important to me. So I have a lot of focus in this general proximity when we're dropping down. I am anticipating PD arrays to form because it's going to be using this old range. So now we have the volume imbalance here at the low of the gap, and then this candlestick's low, which is the high of the gap. Extending it through all of the time distortion of these candlesticks back and forth, back and forth. I'm not paying attention to any of that. I'm looking back where the algorithm made it very clear, left a very clear calling card that this is what it's going to refer to once the market rotates and goes lower. So the market goes lower here, and then we have two candlesticks in here where we can look for shorts inside of this. So now we're inside the candlestick. Open here, we trade up to the high of that gap. Isn't that beautiful? See how that works? And it's also my immediate rebalance. The next candlestick on Thursday, we open, we trade up. We don't touch the high on the previous day. We can't get to the high of the inefficiency over here. And then we roll over and we start working towards running out the low, the low, the low, the low here on the 19th of November. And then we had the inefficiency I aimed for and gave you guidance before it happened.
Okay, so another key takeaway here. ICT is showing you how to identify fair value gaps that are more significant. I'm sure it can get more complex, but I think as a general rule and for simplicity, PD arrays within time distortion are less significant. You want to pay more attention to the PD arrays when price was more fluid and not in a holding pattern. This BISI here was the first one after this rebalance. Also, it's close to the change in the state of delivery here, and it's moving away from this small consolidation, so you can view this as a breakaway gap. And then later down the road, this will be more significant than anything in this time distortion.
We're going to drop down into an hourly chart here. So everything that was on the daily chart, okay, has been shown over the context of a 60-minute or 1 hour chart now, okay? So here's that daily volume imbalance gap that I graded. And then here is Sunday's opening by contrast and Friday's settlement price. So that's our new week opening gap. So we trade up in the lower quadrant of that daily volume imbalance pseudo gap. It trades to the lower quadrant and then breaks aggressively, trades back through the new week opening gap. Notice that once it traded through it, to the downside, it only found its way to finding a retest to the low of the new week opening gap or Friday's close. It didn't have any interest at all in trading into the consequent correction of the new week opening gap. And then it traded lower. Does that indicate bullishness or bearishness? Exceedingly bearish. Why? Because it's not even interested in revisiting the midpoint or consequent correction of the new week opening gap. Notice that? And the market falls off take the low here and trades down into that old buy side inbound, sell side inefficiency that we now have traded down below here, which makes this what? An inversion fair value gap. So we want to watch to see it go up. It trades to the high of it, and that's the immediate rebalance on the daily chart. So we have the immediate rebalance here, and then watch what happens. Watch real closely. The market goes back up inside of that inversion fair value gap. So we come back and we touch the high of it. We dropped outside of it. Now it's validated, okay? We want to see it respect the lower half and disregard the upper half. What does that look like here? Well, this is consequent correction at the 21,319 level. The market goes above that, yes, but does it come all the way back up to the high as it did here? No, it leaves a small little portion there. So the market shows the bodies staying below the upper quadrant at 21,358.25. Yes, the wicks go above it, but that's the part of the price action that's like a gray area. It's not black and white finite. And that's what makes trading a little bit more difficult for people that are studious or academic. Here, the bodies are telling you the story. It's saying that, okay, it's done enough, and it's not hitting the upper quadrant. And even with the wicks going above that 21,358.25 level, it's failing to go back to the high of that inversion fair value gap. That in itself is a signature, okay? So the next candle, we open up, trade up again, fade it. Breaks aggressively, but below relative equal lows. And we get a little bit of a chopping back and forth in here. On your charts and on your notes, this candlestick right here, measure half of that right there, which is consequent encouragement. See the bodies respecting it there. Extend it forward into these candlesticks here, and you'll find something really neat, even on the 15-second chart. That's extra homework, no extra charge. The market breaks aggressively and trades into our first target of 20,640.25 right in here. And then the inefficiencies traded to on Friday. From the weekly perspective, I think about it like this. The market opened up here on Sunday. That's me drawing this line here. That's that price right there. That high is this high here. And as it's dropping down, in my mind, every day of the week, I'm envisioning how it's going to trade down to that low and into this inefficiency. So the low of the week is depicted here. But in my mind, I'm watching how it goes below this 20,640.25 as a draw on liquidity and the top of that.
So using the daily fair value gap and grading it, I do see the inversion aspect. However, trading it, I think it could be pretty difficult. Like for example, here at consequent encroachment, I could see someone getting short after seeing that, but then later getting stopped out before price drops for the sell side target. Now, I don't know, maybe there's a better setup on the 5 or 1 minute time frame, or you need to back test and see this more often for yourself before you can have the confidence to go in.
All right, so this is a 15-minute time frame, and this is the minimum that I think you should have in your journal. Here is that daily gap volume imbalance, as I mentioned before, touching the lower quadrant of it, and here, and finally breaking away, trading over top of the new week opening gap, and then trading right up to the new week opening gap low. Okay, and then it drops from there, and it creates this smooth level in here. And even there, it just got to a point where I expected fully that it would likely try to upset this. And to be honest with you, I was surprised to see it left intact. So I think that that might be something that may get revisited, in the next weeks or whatever, barring any kind of major continuation on the sell-off, right? But this is a really, really logical level for liquidity that's being built up for anyone that's short. And to my thinking, okay, and think about it, say this was to trade down below 19,000 on NASDAQ, okay? Let's just say over the next couple of months, especially going into like May, let's assume that we're in for a deeper sell-off. In my mind, if I was making the market for NASDAQ, I would want to come up here and clear this out. And I'm not saying just go up there by a couple handles, but maybe just like run it up in here, maybe up into this inefficiency entirely. And then whatever rollover after that might be, really exciting. It's just something I have in my notes, okay? So I'm not trying to push it as a hard sell that this is going to go up here to these highs. I'm just saying that it's just really uncharacteristic for the market to leave something that smooth and straight line, especially if it's going to be a precipitous drop later in the year. You know what I mean? So anyway, the market trades below that former buy side and balance sell side efficiency, that when we traded below it here, it changes its characteristic to that of a inversion fair value gap. So since it formed in the basis of a buy side and balance sell side efficiency, when it changes its characteristic to what? Now bearish. So what was usually bullish now is going to be used as a bearish PD array. And this line is that line that I showed you is the immediate rebalance. But you want to do your annotations on the daily chart and let them be seen or visible on the lower time frames. Okay, it's really important you're able to do that. This inefficiency here is the first one after the market rolls over at the beginning of the week. So I want to grade that always. And as you can see here, we're using the volume imbalance of this candlestick's close, and this candlestick's high is the low of the SIBI. But this inefficiency here, I grade that, okay? So the very first inefficiency that forms once the week starts, really important. It's along the same premise as the first percent of the fair value gap. Like a new week opening gap, you extend them throughout the entirety of the week, and they're going to be utilized again. But in this case here, because we have a directional bias, it's bearish. The high of it to the low of it, and then the consequent encouragement. Look at the consequent encouragement midpoint. See how the bodies are respecting that? Yes, there's little inherent wicks above it, but that's permitted. That's just like coloring outside the lines. This is indicating that we're not likely to go higher. So if we're not likely to go higher, and we can't even close in this little portion here to that candlestick's high and that candlestick's low, that makes this a candidate for a breakaway gap. It's also occurring right at the low of the new week opening gap. See how these things blend together? When there's not just one level of information being presented to you with that one gap, there has to be other things in agreement. It's like a confluence of things. So just simply because there's a 3-candle formation and there's a down closed candle in the middle of the 3 candles, that doesn't mean it's an inefficiency that I'm concerned about. It has to have something along the lines of time. Well, what's the time aspect here? It's the very first displacement after the start of the week in the direction of my draw on liquidity, which is a lot lower on the daily chart. Because it's the first one, I want to see, does it perform and show signatures of breakaway? Breakaway means it's like rocket fuel. It's going to really set my directional bias on fire in terms of the magnitude, the speed, the ferocity, and how fast it wants to go there. When we had this delivery here, below that old buy side and balance sell side efficiency, it acts as a inversion fair value gap. Scrubbing over to the right a little bit, that's that move we just talked about here, and it climbs up. Look how it uses the low of that old buy side and balance sell side efficiency, but we're expecting it to perform as a inversion fair value gap. Look how it uses the grading or the quadrant levels that's been added to it. Low, lower quadrant, body's just outside of it a little bit, and then rallies up, lower quadrant, consequent encroachment, high, immediate rebalance on the daily chart. Monday's low, it touches, okay? So Wednesday trades up to Monday's low, immediate rebalance on the daily. Notice I added the annotation there. You have to be diligent about keeping record of what levels you have when you're doing your back testing and journaling. So the market drops from here, outside of it once more. So that validates this now as an inversion fair value gap. So we're going to watch this midpoint to the high. We want to see it disregard this upper portion. The market trades up, creates the low on that candlestick right at the low of the inversion fair value gap. Trades down here, gyrates around consequent encroachment, shoots up in the upper quadrant, fails to touch the upper half. And anything rolling over from there is ideal. What is this low and this low? You can't recognize it easily when it's zoomed in like this because you're too close to the trees to see the forest. These would be relatively equal lows on the daily chart. But right here, watch what we're doing. We're going to scrub over, and that's here. Market breaks down, trades precipitously lower, and then we have this gap here. Why am I not using this one here? Because it left that inversion fair value gap. I naturally want to see that always act as a breakaway gap. Okay, that's for the people that are paying attention, no extra charge. But the next one after that, we've taken this low out and we traded into liquidity. Now we're going to have to use this information here. So this candlestick's low, this candlestick's high, grade that. Look at the body stopping, rated consequent encroachment. The wicks are allowed to do damage, but notice they're not going higher each time, they're going lower. And then lower quadrant here, breaks aggressively lower and then trades into our 20,640.25 level and then into the buy side balance, sell side efficiency that I gave you as the low end target on the daily chart for NASDAQ.
Okay, so I let him talk for quite a while. Basically going through the price action, you can see how the lower time frame adheres to the higher time frame PD arrays. Remember to use the price delivery continuum, going through multiple time frames to find confluences and derive the overall narrative. One point he does make is when you do this, make sure to label your drawings with their respective time frame so you don't lose track of where price is going and where it's moving away from.
Here's Thursday's opening range gap, and you can see it with the regular trading hours. So here's the opening price at 9:30 and regular trading hours settlement price. So we open up inside the inversion fair value gap. Okay, we fail to get to the upper half. We break lower aggressively, and notice it doesn't even do a return back to the first presented fair value gap. It doesn't even come back up and touch consequent encroachment. It just falls out of bed aggressively, and it doesn't even come back and touch the low of the inversion fair value gap. So my attention went to, okay, well, we're not showing any importance placed on any of the levels I have inside that inversion fair value gap. It's exceedingly what? Weak. So if it's weak and my bias is bearish, we're going to get down here real quick. So the only thing I could do is when I gave guidance, I said the opening range gap low is providing or lending resistance here. And that was pretty much all you get. You have a small little institutional order flow entry drill here. Then you have an inversion fair value gap here. I'm not adding all that because when we broke down here, this is a bearish fair value gap. Trade up into that, and that was all she wrote. Breaks aggressively lower. And as we traded down into it, ticker tape parade. Yay, ran on this again. And then I was done for the day with Telegram. And the market retraced back up into and consolidated and then created an afternoon session run. As I taught recently and in 2024 content, paid mentorship students learn this also in the day trading modules. You can find all this stuff in the lectures on my YouTube channel. So at 1:30 p.m. Eastern time to 2 o'clock, that's your opening range for the afternoon session. Same thing we do at 9:30 to 10 o'clock in the morning for the opening range in the morning session at the opening about 9:30. Well, your afternoon session, you want to use this 30-minute period, okay? Small little gap in here, but the largest, most prominent one is here. So market trades up into that. The body stays inside of it, respects it, and then breaks away during the 150 to 210 macro, as you would expect in the direction we're looking for. It trades down lower. It trades below the 20,943 level, which is February 3rd sell side liquidity pool, daily chart. Look at that. These are the levels I gave you in advance before it happened. The market trades down, consolidates in here into the 250 to 310 macro using this sell side bounce, buy side efficiency. It fails to do what? Work inside the upper half. That's exactly what you want to see it do. The algorithm is flagging and saying, hey, hello, I'm about to go lower quickly. And then the market drops out during the 250 to 310 macro. One more fair value gap in here, and it dives down in. And then you have market on close, which is the 350 to 4 o'clock. That last little flurry of activity where the markets are being driven algorithmically, and the market drives down one more time below the November 19th, 2024 low for the sell side, dives down, falls just short of that old inefficiency that I told you it would be a target on the downside on the daily chart. Okay, and on Friday, I was not able to spend time with you all. I was, like I said, in my fields and doing things in my personal time. Opening range gap and first presented fair value gap in white. So the market trades down into it there, rallies up, one more time digs down into it, and then we have this little gap here. I wasn't watching at the time, otherwise I would have bought it there. But inside here, once we traded down into that, I went long and aimed for just a simple little buy side liquidity pool. They got out on this run here, and it retraced all the way back down in and went lower than the first presented fair value gap, but didn't take out the low. So it's a lower quadrant of that blue shaded area on the daily chart. So remember, what this blue shaded area is the very first chart I showed at this recording. Go and add your gradients on that level based on the daily chart, and you'll see where it's trading down to here. Then it rallies back up above the opening range gap, down into first presented fair value gap once more for the afternoon session. and then rallies up and trades back to February 3rd's old daily low at 20,943. So it's a really nice run, but I'll show you some executions here. I went long into this gap here, and then these relative equal highs, there's buy side there, and there you go. So I'm highlighting there so you can see the actual little caret entry right there at the top of that gap. That was my entry. And then the price level, you can see at 20,685.25. That is right in this proximity, which is right above here is what I was aiming for. And that's what that exit is. So it's a quick little, grocery getter type setup, simple, easy. And then after it takes my target that I gave you on the daily chart, then I can start working towards doing reversal patterns with a greater degree of confidence.
Okay, so I didn't have much to add towards the end there. Pretty good lecture, a couple gold nuggets to take away, but most of the time he's just running through the price action from the higher time frame down to the lower time frame. When he does this kind of lecture, you really want to take your time and follow along through the multiple time frames. It'll help you navigate the price delivery continuum, and you can see how price is fractal. Note that he's showing you what stands out to him, and with decades of experience, you'll also want to use what he's showing, but he does go to say that if anything else stands out for you, take notes on it, study it, and see if it's something that speaks to you that you can use in your own trading. So take your time as you mark up your charts, turn it into a meditation practice, and you may uncover something that was there all along, but now has come to light and into your awareness, and will help you along with your trading journey. So that's it for this one. I hope you've enjoyed it. Please leave this a like and subscribe if you have done so yet. We're just 2 months into the year, so there will be a lot more lectures to go. But until the next one, safe trading.